Here you have examples of accounts within Group 1, Basic Financing. The account 100 is share capital, an equity account which stands for the price the owners paid for the shares. Also, an equity account number 129, profit or loss for the period, is the difference between income and expenses for the year in the balance sheet at the end of the fiscal year. Hence, the account 170, non-current debt with financial institutions, is disclosed within non-current liabilities. Examples of Group 2 non-current assets are, for instance, the account 211, buildings, a kind of property, plant and equipment assets, the permanent productive structure of a company, which includes subgroups 21, 22, and 23. The account 252, non-current loans, is an example of long-term financial investment originated by loans to third parties. Here we have two examples of inventories accounts within Group 3. 300 merchandises, which are inventories in a trading company, and 350 finished goods, the final output in a manufacturing company. Both are current assets, since they will be derecognized when they are sold before the business cycle terminates. Among Group 4 accounts, the more typical ones are number 400 and number 430. Account 400 stands for suppliers, which is a trade payable, that is, a debt or liability for purchases of inventories and services received from other firms when they are not in cash. Account number 430 is a trade receivable from customers, whose debit balance, since it is an asset, is the amount the customers owe us due to sales and services rendered on credit. Within Group 5, we may find these three examples of financial assets and liabilities. Account 520, current debt with financial institutions, which, as you can easily deduct, is a current liability in the balance sheet, and two examples of current assets. Account 540, current investments in equity instruments, which stands for the value of shares our company possesses in other companies' equity, and account 572, banks and financial institutions demand current accounts euro, disclosing the balance of a company's typical bank account. We have previously mentioned that the account 129 stands for the result for the period in the profit and loss account, as the difference between income and expenses. This number is recognized as equity in the balance sheet at the end of the fiscal year. In order to disclose the components of the result for the period, we use Group 7 accounts for income and gains, and Group 6 for expenses and losses accounts. In terms of journal entries, in the column on the left, we debit expenses, equity reductions, and in the column on the right, we credit income, equity increases. Please notice that the profit and loss account or income statement is, in fact, the general ledger or the balance sheet account 129. As explained in the slide before, here you can check the full definition of Group 6 and 7 in the Spanish General Accounting Plan. Accounts whose first digit is number 6 are purchases and expenses. Accounts whose first digit is number 7 are sales and income. For instance, within Group 6, we may find the account 600, merchandise purchased, which refers to the cost of procurement by the company of trading inventories included in subgroup 30. The account 640, salaries and wages, expenses related to the remuneration of company employees, or the account 681, depreciation of property, plant, and equipment, which measures the systematic annual decrease in the value of tangible non-current assets upon use in the production process. As for Group 7 accounts examples, we can remark the account 700, merchandise sold, which stands for the price of transactions involving the outflow or delivery of goods and services forming part of the company's trade operations. The account 766, gains on investments and debt securities, gains generated on the disposal of debt securities and equity instruments when the cash inflow of the disposal is higher than the carrying amount of the item disposed of, or the account 771, gains on property, plant, and equipment similar to the previous one, and when the asset disposed of is a tangible, non-current asset the company has been used in its production process. The trial balance discloses in a single document the balances of all the accounts and their movements during the fiscal year. It means that the trial balance is a compilation of the general ledger of every account, disclosed in each row. The first column refers to the name of the account. The next two columns show the balance of the account at the beginning of period, debit for assets and credit for liabilities and equity accounts. Columns 4th and 5th disclose the movements previously recorded in the journal ledger by means of daily journal entries. Columns 6th and 7th present the balances of the accounts at the end of period, debit for assets and expenses, credit for liabilities, equity and income accounts. In order to elaborate the balance sheet, at the end of period, in the trial balance, we add two regularization columns, so as to sum up the income and expenses accounts balances into a single account. This account is number 129, profit or loss for the period. As a result of the regularization step, in the last two columns, we have exclusively the accounts that will be disclosed in the balance sheet or statement of financial position. Balances of income and expenses accounts are now zero, and account 129 shows the difference between income and expenses accounts balances for €47,000. As a way to go over this lesson, I propose you to try to solve this example. Company A is funded at the 31st of December, year 0, with a cash balance of €100,000 from its owners. At the 2nd of January, year 1, A buys a truck in cash and hires a driver. Cost of the truck, €60,000. Estimated useful life, 5 years. Financial data as of the end of year 1, freight revenue, €90,000, wages, €30,000, fuel costs, €20,000, taxes, €1,000. You must elaborate balance sheet at the 1st of January, year 1, journal ledger until the 31st of December, year 1, ledger accounts until the 31st of December, year 1, trial balance at the 31st of December, year 1, profit and loss account at the 31st of December, year 1, and balance sheet at the 31st of December, year 1.